What is winning and what is losing in the aftermath of what's been going on in the Persian Gulf? We're going to talk about that a little bit today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. We've seen some pretty big moves this week. We've talked a little bit about that. We talked a bit about it on office hours with Professor Mark Guthner of Rutgers yesterday, and I touched on some of these things earlier. One of the things I thought was kind of interesting was how the dollar has behaved. The reason I bring this up, and by the way, I have to apologize for my appearance. I'm not trying to do some kind of European sort of thing here by keeping the open collar, but apparently I'm missing a button. I'm not sure what happened there. Not trying to get all racy on the program, so to speak. So one of the things that was interesting to me, because I happened to have noticed that gold had sold off a little bit, was taking a look at how the dollar has behaved. So let's just take a look at this first. And one of the things we'll notice is that the dollar managed to catch a little bit of a bid here, as we can see. And the reason I think that's important is because what that tells us is that while a lot of us have been talking about the dollar debasement trade, it still remains a significant area of concern. Our fiscal house is not in order. We are still seeing considerable Treasury purchases by the Federal Reserve Bank. But for those that were calling the end of the dollar as sort of the reserve currency of the world, I think what we're seeing here suggests that maybe that's a little bit premature. A 1% move in the dollar in just a couple of days is pretty significant. The currencies don't move that much. But more important even than the magnitude of the move is its direction. In other words, is it positive for the dollar, worse for the dollar? And it would seem that, at least for now, the indication is that it is positive. And we have to remember that as we start taking a look at other things that can sometimes be viewed as safe haven assets, because they're going to be priced in dollars, but they're more global commodities. So that could be the price of oil, that could be the price of gold and silver, things like that. So we need to sort of adjust in our minds what is going on with the dollar globally as we also think about the prices of those other commodities. So the other thing I was taking a look at, and I don't know if I've ever shared this, I'm pretty sure I have. This is just a heat map. Obviously, it was a pretty decent day today, but I wanted to sort of show what is working and what is not. This area, I think, is kind of interesting. You can see down here as we look at the S&P that consumer discretionary, you can also see that in this table over here, is the best performing. And we can actually drill into this a little bit more. The autos doing very well. We can go into here, take a look at the securities, and see what's working. And this is really where the big gains are to be found. That's probably not that surprising. This is cap weighted. So when you look at this, just recognize that General Motors is, big a company as it is, Ford, big a company as it is, in market cap terms, and the S&P is a cap weighted index. These things really don't matter that much relative to Tesla. But I think it is important to show that they too actually have performed reasonably well in here. Unsurprising, Tesla is going to have a much bigger impact. It's a much bigger company. And then as we take a look at information technology, the other thing that we're going to be interested in taking a look at is, are we still seeing some decent strength in software and services? Because you may remember that on Monday and I think yesterday, I highlighted the fact that IGV seemed to be stabilizing relative to hardware after a period of profound underperformance. So let's just take a look very quickly at constituent stocks inside of IGV, and that's going to include Microsoft, which honestly, I don't think I had fully appreciated how far this one had fallen And it wasn't until we really started to examine this with this topic yesterday with Mark that I recognized that Microsoft is now, in fact, trading at about 20 times forward earnings, which is, really quite reasonable. When we take a look at what this thing has been doing in terms of its multiple, has it been cheaper? It has. Several years ago, it actually got down to the very low double digits. We were talking about low teens. And then it got up to as high as 30. We're kind of in the middle right now. And I think that's fairly reasonable when one takes a look at, the kind of top line growth expectations that we're looking at here. When was the last time that you were able to get a company that's got a 15% top line growth? Right now, the street's looking for about 12.5 in terms of its adjusted EPS. This is the only fly in the ointment. I've sort of alluded to this on more than one occasion, the fact that the CapEx is just getting huge. But I will offer the same thing about Microsoft that I have done about Meta in the past, which is that, and in fact, actually, to illustrate this, let's do this really quickly. I'm going to go back quite a ways in Meta. So we're going to take a look at the metaverse. I don't know, shall we call it a debacle? Or we can call it whatever we like. But as we go back several years, one of the things we're going to see is that we had this big swoon in Meta. Well, there was this big swoon over here in 2022. The market was down and we had that big gap. But this was, quite a remarkable period. And one of the things that was going on here is that used to be known as Facebook, now it's known as Meta. One of the things that caused this to perform so much worse than a lot of other companies did coming out of 2021, this decline in percentage terms it's almost hard to believe. You kind of have to refresh your memory at times just how severe some of these downturns can be. This is what happened in Meta, and it was not just because the S&P between 2021 highs and the lows in 2022. This was the rate hiking cycle. We almost got into a bear market. I think we had an intraday bear market in there, but this fell much, much more. Why was that? Well, just take a look at the clock here. So we're paying attention. We're going to take a look. We're going to go back and look at the financial statements dating to the tail end of 2019, and then we're going to fast forward about 5 years. So let's do that now. So I just have to wind the clock back here. I'm sure our crack production staff will be able to blow this up a little bit, and we can sort of see what's going on. All right. So what was happening at this time was, I might go back even a little bit further here. This is the number, and it's kind of funny when we think about this now, because this seemed like profound spending at the time, and now in the context of AI, these figures are going to seem kind of trite. But really what was going on here was that as the company began to commit to the concept of the metaverse, they started throwing a lot of money at it. And what we saw was that their CapEx, you can see in here, $15 billion in 2020, more than doubled to almost $31.5 billion by 2022. And this corresponds with the time that the stock just rolled off a cliff. And what was going on, for people who don't remember what the narrative was at the time, the issue was that people said this metaverse thing is a total non-starter. And Mark Zuckerberg, there's multiple share classes. He controls the voting shares. And there was this concern that you had somebody who was totally committed to this idea and that he should be committed because the idea was a bad one. That was sort of the investor narrative that caused the stock to decline by almost 80%. Well, Mark is the biggest shareholder of the company, and he doesn't need to be committed. He is not an idiot. And who knows, is it possible that the metaverse could have turned into more of a thing than it ultimately did if he had stuck with it? I don't know. He ended up pivoting. He decided, okay, we're going to pull some of this back. Their investment in that area started to decline, and you can actually see between 2022 and 2023 that their capex dropped. It has subsequently started to ramp back up. The reason it is ramping back up, of course, is because now they're focusing more on AI. Fine. The same question, people are more enamored of the AI story than they were of the metaverse story. The point that I have made about, or was making about metaverse, I'm not making it quite as much anymore. But one of the things that I had talked about was that let's just say that this investment proves to be money down the tubes, right? So let's just say that you invest $70 billion in data centers because you think that's what you need to succeed in the modern AI world, and you wake up 18, 24 months later and suddenly say the same thing that you said about the metaverse. You know what? We committed too much resources to this. That was in error. We are going to pull this back. Well, if that's all that you do, you are a data center business, you're kind of screwed. But if you are Meta, or alternatively, if you are Microsoft, no. These are very survivable types of mistakes to make. You can take a look at this massive CapEx here, and what I would encourage is, in the midst of looking at that massive CapEx, remind yourself that net of all of that, you're still going to have close to $81 billion in free cash flow, and that is still less than 1 year's net income. Do you want to lose $127 billion? No, of course not. Is it an existential risk for the company if they do? No. It's a meaningful hit, but it's not the end of the world. Actually, you know what? Completely unrelated. Let's do this. Because I'm actually kind of curious, because it might give us some sort of relative sense of things. So let me go back here, see how far back this goes. Okay. Well, that one's not so great. But let me go back one more. So what I'm showing now is the net income of Goldman Sachs through the GFC, right? So if you make this investment, you write it all down, it's going to hit your net income. It is kind of a similar order of magnitude, right? So we're looking at 142 billion bucks, $120 billion worth of capex. Maybe that's closer to 90%. But what I'm saying is that companies that have tremendous profitability, tremendous free cash flow, can afford to make mistakes once in a while. I'm not saying it is a mistake. I'm just saying you can afford to make one. And because you can afford to make one, the question you must then ask yourself is, okay, if this is the reason why people are selling this off, if this is the reason why, I'm not interested in owning the business, I would say, okay, fine. Call it a mistake, and then ask yourself whether or not you can live with the stock at 20 times earnings if the investment that they're making in this future isn't what everyone thinks it's going to be. And the short version of that is, yeah, I think so. Now, on a technical perspective, because the stock had been so hard hit, the next question we need to ask ourselves is, has it regained its footing from a technical point of view? And here, it's a little bit more difficult because we're well below the moving averages. But I would also say that having looked at IGV, let me see if I can pull that up on another one. I began to wonder if maybe, just maybe, we might have started to find our footing here. So basically in this downtrend, And now, are we starting to level out? It seems like we're getting a little bit of strength in here. Is this for real? Is this for keeps? I don't know, but I will say that the fundamentals in some of these companies seem very much intact to me. If some of the investments they're making are, if they prove not to be as successful as everyone hopes, they can live through it. And this is really the question. We're just making sure that this whole area is finding its footing. So this is a This is a rotation, an industry rotation within sectors. And I think that, maybe it might begin to make some sense sometime soon. Not everything is sort of catching up, but we're seeing it's becoming a little bit of a mixed bag. But I think we're probably going to start getting close to kicking the tires here. And one thing that somebody might consider doing, actually, and we can see their relative strength is improving. Let's see if we can possibly frame up an options trade that could capitalize on a bounce if we continue to see it. Unbelievably, and I can tell even just by looking, I'm not even going to bother to hit the login button because it was going to ask me again, do you want to update your password? Yeah, okay, but doesn't stick. You're going to have to figure out what's going on there. I'm being told it wasn't asking me to update my password. What was it asking me? Oh. The one that I added was in a data breach. Yeah, okay. I'm not that particular password because I don't use it for anything else. Doesn't concern me very much. Okay. So let's just take a quick peek here and let's find out what we can pull off. We are at 85.70. I would probably lean towards something along these lines. Like that. So looking to spend something on the neighborhood of a quarter of the distance between the strikes for an upside call spread that runs out at least till May or thereabouts. We will have to revisit whether there's going to be a sell in May and go away or anything like that. By the way, I don't know if anybody happened to catch it, but Tom Lee, I think he was on CNBC. It was either yesterday or last night. His comment was that, he thinks that the market actually has some legs through the end of March. So that's just a general market bit of color and commentary from somebody who's outperformed the S&P for a couple of years in here. But I'm getting more interested in this space. I wish we had something a little bit more convincing on, getting through one of these declining moving averages. That usually takes a little bit more time to play out. If it were not for the fact that it has not accomplished that, I'd probably just say it's time to start picking up the underlying stocks. But if you're thinking this could be the sign that it's going to do that and you want to get a little bit in front of it, then something like this would be kind of a low risk way to play that. All right. Let's take a quick peek. I'm going to see whether I have any questions from anybody. All right. And I apologize, by the way, for seeming a little unprepared. I was on a conference call and the producer called me and said, "You're not logged on. The camera's not on." There were 3 minutes to go, and I was actually on a conference call at the time. Okay. So I'm being asked, can you crunch the total return numbers on Winter since I bought it on August 11th, 2025? Yes. So August 11th, 2025. 83.39% is the total returns. And Mr. is down 63.4. So for people who don't know, obviously you guys know what Mr. is, what strategy, formerly known as MicroStrategy, is. By the way, okay, I wanted to make sure I put your question up on the screen, because nice timing. I think the peak in strategy was actually July 16th. So, you know, you were 3 weeks after, but you recognized something was breaking and you got right to it. So you got most of the potential gains by doing that. Well done. What are these things? So Strategy is a Bitcoin treasury company. For anybody who doesn't know, it's almost impossible, though, that any of you watching do not. That's the one that's run by Michael Saylor. And Winter is one of our funds that is an options income strategy that takes a bearish stance on strategy stock. We have a bullish one too, and that's Misty. And you can see that total return has done better. This was the bullish one. So the bullish one has, and that's this in both cases, just so we understand the assumption set. In both cases, this is assuming that you own the fund and you reinvest the distributions that you get back into the security. So that's kind of a standard way to do a total return calculation. There is another way to do it, which is not standard, and I'll explain why if anybody's interested. But another way to think about this is to say, well, what if I bought the security and I did not reinvest the distributions and I just took the distributions, right? So I'm going to go back to the same period you had here, which was August 11th. So if you did not reinvest the distributions on that date, your total returns would have been less. Oops, what am I doing? Oops, sorry. What am I doing? What is MNTR? I put in the wrong thing and it had, that's interesting. Yeah, it had almost the exact same returns. Do you see that? Mentor Capital. I'm curious what Mentor Capital does. Okay, so if you had just simply taken the distributions, and this is actually assuming that you took the distributions in cash and they went into an account bearing this rate of interest. And the way Bloomberg does this calculation is it just pulls in whatever the overnight risk-free rate is. So if I'd gone back in time when rates were higher, it would have a different assumption. We can also override that and say, you know, I don't get 3.7%, or I didn't get 3.7% in terms of interest on that account. I only got 2. So, okay, so we put in 2, and you'll notice that the calculation changed somewhat. So that's the rate of return there. Now, this, whether you reinvest the dividends or not, and how that impacts a total return calculation makes a huge difference over larger periods of time when the underlying asset's performance deteriorates materially. And to illustrate this, I'm actually going to take the long version. So Winter is our short version. And I'm going to put that one in. And actually, I'm not going to go back to here. I'm going to go back to the beginning of the year. And I'm going to put in Misty, which is the long variant. And here you can see, well, strategy is done abysmally. I mean, I think we saw before that the returns were, in the negative 66% or so. Oops, I didn't mean to go. I want to go back all the way to the beginning of the year. So 12/31/2024. We'll go like that. So you'll notice that this return right here, this negative 47.6%, that's assuming you get a distribution and you reinvest it, and then the next time you get a distribution, you reinvest it. So you're never taking any money out or leaving it on the side. What ends up happening, of course, is that because you are continuously reinvesting it in a declining asset, now this happens to track what what strategy stock was doing, you don't end up mitigating as much of the negative performance as you might have had you simply just taken those distributions in cash. And as you can see, if you do that, that has a profound impact on the potential downside. So from 12/31/2024 to present, if you had bought Misty on the last trading day of 2024, held it to today, didn't reinvest your distributions, just took those in cash, you'd be down 11.2%. I'll round up. But had you bought strategy stock at the same time, you'd be down 54.2, which is, I don't think I need to do any of that simple arithmetic for anybody, but that is considerably worse. And that's the impact that distributions can have. And actually, I want to just show how and when those would have been impacting so you can get another visual. I can actually add those distributions in here. So you can see that you would have been getting distributions along the way. That first distribution was, almost $2.28 a share, and that's on an adjusted basis. $2 a share, $1.38, $1.33.5, $2.37. So this is, here's a simple way to think about it. Add all of those up, $1.47, July, $1.24-ish. And I'm going to use this as the last one because then this thing really started to roll over, $1.18. You would have collected all of those distributions. And of course, what that means is that a lot of your initial investment had already been paid back to you in cash. So your, subsequent exposure is going to be much less. How people decide to reallocate, obviously that's going to be dependent on a whole lot of things, including, how you feel about the underlying asset, how you think about the underlying assets, implied volatility, the price of options. That was a big tailwind for people who were short options in Bitcoin, the complex. So that's going to be Bitcoin itself. So companies that would sort of trade alongside of it. So that's going to be the miners, the treasury companies, you name it, right? All right. So Jim Howard, wondering if you might think HPQ at somewhat of a bottom here for a short-term 20 to 60-day option play. RSI has been rising. Buy calls or sell puts or no? Thanks. Okay. Well, let's just take a look at the technicals and see what that gives us. We'll actually start first with the technicals function in Bloomberg and just see how this stacks up. These are the best performing technical indicators. And it would appear these two are the only two that really outperform the market, but by virtue of stochastics and parabolic, we've kind of got a mixed bag here. But let's just take a look and see how this one looks first. So that was close and go short right there. So this has not really done too badly, one would say, with its timing. Bought here, sold. Covered, went long. Sold, went short. Not terrible in terms of its timing mechanisms. I'm not necessarily going to, say that, I'm not a technical analyst. All I do is I use the systems that are provided to me to rank the best technical indicators for a given underlier. So by its work, maybe not. I'm more likely to just simply take a look at a chart this way and see whether it looks like, So not great. Here's the thing, remember when I was looking at the IGV chart, this part looked the same. And it does look like it's starting to flatten out here a little. But unlike IGV, we haven't seen it start to sort of turn up here really very much. It is kind of a similar pattern. And I'm going to add IGV in. Maybe we can overlay these two. See if we can see a little bit of a oops, what happened here? Okay. So IGV, to me, it feels like it has rebounded a bit more sharply. So that's IGV highlighted in blue. I probably should have used a different color and it just defaulted to this. But I'm going to put IGV in red. And the reason is because the blue candles are just making it a little bit murky. So IGV in red, I'll highlight it. These things are tracking, fairly comparably. Just does feel like it bounced a little harder to me. And I was really kind of looking for it to violate that downtrend line. HPQ, it does seem to be leveling off, but maybe not quite so much. Now let's just take a look at the fundamentals, see what we think. Not a grower. A lot of debt, or a decent bit of it. Where's my calculator? Good free cash flow. Yeah, I mean, so what are we looking at here? We'll call it, I'll just use 2850. So 2.85 billion. 25.3. Wow. 11% free cash flow yield. But yeah, this is a company that's sort of been in decline now for some time. I think any and all of us can kind of remember when Hewlett was one of the penultimate sort of technology companies, well thought of for their scanners and printers, and at one point one of the higher end machines on the PC side, but they really have kind of fallen by the wayside. So let's see what we're looking at a little bit further. Now this actually is kind of interesting. What catalyst is going to suddenly create a big bit of EPS growth and wider margins? Does the income statement get forecast? It probably doesn't. Let's see if I can see a little bit more resolution on this. Where are they expecting these savings to come from? Because you don't have the top line growth to pay for this, so they must be forecasting something else. Yeah, I mean, it wouldn't. Here's what I would say about this, is that it looks a little bit early to say that it has pivoted from a bearish into a potential bullish reversal. Let's check one other thing. We got some catalysts coming up here that could potentially do something here. Did this influence your decision at all? I'm curious. So apparently they participated at the Morgan Stanley Technology, Media, and Telecom Conference. Did we get a presentation? What's this? Well, that's just their earnings. Yeah, I mean, well, first of all, I think you guys know it wouldn't hit my screens. Doesn't have the top line, doesn't have the bottom line to do that. And It actually doesn't hit my technical screens either. But it is cheap on a multiple basis. I guess you could argue this is kind of like my IGV thinking, but it's a little bit earlier than my IGV thinking. As you can see, the performance in IGV has it's caught a little bit harder bounce, caught a little bit more of a bid, and kind of licking my chops, got my eyes on it. Could Hewlett be the same thing? It could be. It hasn't confirmed anything material yet, but why don't we'll structure a long options trade in it anyway. And maybe you can. I'm sure you've driven in traffic and you cover the brake, right? So this is a situation where you would cover the brake. There's stuff going on here that doesn't look so great, but you kind of want to keep going anyway. So covering the brake simply means that your foot's over the brake pedal. You're not stepping on it, but you're ready to. Anybody who's ridden a motorcycle probably knows even more about that. Although it can be very hard to cover the brake on a motorcycle if you've got your hand on the throttle at the same time, or at least for me anyway. Let's see here. And no, I don't ride one anymore. My wife made me stop doing that before we had kids. So no more motorcycles for me. Let's see here. Yeah, I mean, this would be kind of a similar structure to what I just discussed. This one's in the money, which I probably wouldn't do. So something along these lines. 2023. Not an expensive trade. 75 cents a share, $75 a contract. And is, again, 25% of the distance between the strikes, $3. So you're right there. So I'd be okay with making a play like that, I guess. But it certainly hasn't confirmed in any meaningful way, right? And the same admission I'm making about IGV, and I think IGV is closer to confirming than this has. Okay, FinWest. Crowd came through for me per earnings. Now watching Broadcom. You're in style. Please do your shopping at Lulu as my position still needs help. We did shop at Lulu when I was in Waikiki. We were out on Oahu, and yeah, we went to that huge mall there. I'm trying to remember what it's called, and we did stop into Lulu because if you have. Yes, the producer said, is that because Amex brought you in? And the answer is, yes, it is. I mean, my wife still really likes Lulu, but, when I was able to say, oh, I've got a coupon at Lulu, or I get a refund if we... Actually, let me think about this. When did we go there? I think you get a coupon every quarter. So, if that's true, so that was during Christmas. Have I gone back since? I might be due. Ala Moana, exactly right. By the way, for anybody who has never been, that is a big shopping center. I mean, it is really big. In fact, that whole area is a consumer's mecca. I mean, I don't remember too many places where I have walked. It's an outdoor mall, multi-level, huge, has everything. You can go to the Yeti boutique if you want. You name the brand, they've got it. But the more amazing thing about that whole area that I found really interesting was that as I was walking through the mall, they had a lot of brand-specific boutiques. An example, walking along and I saw a Grand Seiko boutique, which is part of the Seiko family of watches. It's one of their high-end brands. And I thought, oh, that's interesting, Grand Seiko boutique. I think later that day I was walking in just another area, still walking distance, and I passed another one. And then I thought, I think that's also the second or third Rolex boutique I've seen. It's not just that they have every one of these stores, it's that they've got many of them. Several luxury brands have several boutiques, all within a relatively compact area. So I don't. It's not my interest to go to Hawaii to go shopping. I'd rather hang out and enjoy the weather or do something outdoors. But if you ever go there and get bored, and you are a consumer, that's a place for consumers. That much I can certainly say. So as for Lulu, I will admit that part of the reason I went there was because part of the benefits for your American Express card is that you get these rebates. I think they just basically credit you back on your statement. And actually, now that I think about it, I get some for some restaurants. If you use Resy, the app Resy, and you have an American Express card, do these things. I will tell you, this is just as an aside. I was kind of thinking that maybe this could drive a little traffic to Lulu, but they had that setback. So they had a controversy at Lulu several years ago, and in that they released these new stretchy pants. If we think about Nacho Libre, and it turned out that some people complained they were transparent or translucent, depending. If somebody bent over, you could see through them. And apparently, and they got past all of that. And then they introduced a new line, and it came back. And I thought, this is really, how could you make the same mistake? I mean, to me, that almost seems unforgivable. It was such a controversy the last time it happened that you would say, okay, we're going to introduce a process. Like, something didn't work in the process. So we designed some apparel, we manufacture that apparel, and we let it out to the public, and it had an obvious flaw. What was the flaw? If you bent over, you could see through it. People don't like that. Okay. Where did we go wrong? You fixed the process. Shouldn't happen again. I mean, what do? You wait until someone's like, same thing? I mean, if you send food out to your customers at a restaurant, and it's undercooked, and they send it back, don't make the same mistake the next night. I just don't understand that. So, the founder, Chip, what's Chip's last name? I can't remember. He was complaining vociferously about this. But, the company, I'm hoping they sort this one out. And I do think American Express rebates or incentives are going to help because, I'm not a shopper, but I will mention something to my wife like, oh, you want to go to Lulu because, I've got a credit's going to expire at the end of the quarter. You might as well go. And, it's trading at an awfully cheap multiple, and it's still got decent free cash flow, or it's forecast to. It's getting pretty borderline, as you can see over here. From my screening perspective, this one would probably not show up on things to look at if you don't already own them for two reasons. One, this is sort of below that 5-ish number I'm looking for. They've got some, we just talked about one of the issues that they're facing, so we would expect to see a little bit of fallout when you have a big misstep that upsets your customers. That can be overcome, though. So as long as the top line's growing, you gotta resolve. We have some merchandise. We've got to take it back, and then we're going to have to fix the process. That's going to cost. They can afford to pay it. The balance sheet is still absolutely fine. Good free cash flow, and it is cheap on an earnings basis. But this would not pop up on my "Hey, buy it now" screen if you didn't already own it. We also need to see, I think, for a few more quarters, how much of an impact the incentives that American Express is now offering to this and other vendors, and whether that has anything, if it has a material impact. And if it does, I actually think that's going to be a real strength for American Express because if you add up the incentives that you have on these card members for American Express, I think it's going to be a powerful selling point for them to come up with incentive programs with other retailers. If people remember. And the thing is, they're going to make more of an effort to remember because American Express increased their membership rates considerably. I don't remember what the annual card rate is. I think I just saw it. $8.95 is the number I have in my mind. That's kind of a lot, right? And I was looking at my American Express statement, and there was the $8.95 fee for that, but I have more than one American Express account because I have a Hilton Affinity card or something. And I was looking at that, and I was like, is that $500? I don't remember that. I kind of remembered that I got this thing, and I just got some free points. And it was actually trying to entice me to upgrade to some new, better Hilton Affinity card. So I have a American Express Affinity card, and it was like, click this button and become a Diamond member overnight. And I almost clicked it, and I was like, wait a minute. That's just a way to get me to pay $500 a year for a Hilton card. And maybe it's a better idea since I don't stay at the Hilton that often that I just keep the 500 and I can apply it to my next stay. Is that a better deal than becoming a Diamond member? I don't know. But yeah, I think the valuation is kind of compelling. So you got earnings coming up. Let's take a look what the market's implying. In line, 9.8%. So this is actually, I think this is actually a fair, those options are not cheap, but they're not expensive. And they're not expensive because take a look at this. I mean, this thing has been moving when they've been reporting. So let's take a look. Yeah, I mean, if one's inclined to make a bullish bet, it sounds like you already own it. I'm not sure that I would get totally net short premium in this going into the print. And that's, I would want to spread it because an at the money straddle costing 10% of the current stock price, that's pretty chunky. But we'll just put a call spread in here, just one maybe that expires. Come on. What you doing to me? All right. Oh, Options Play's got a little Mideast tracker there. I wish I had waited a second longer if this thing hadn't been delaying to figure out what that was all about. Maybe worth a look. But if we just go out to the 20th and we say, okay, what about like a 175? Oh, like 175, 200-ish, something like that. $7.19 on a 173, so call it $7.20. 4%. 4% of the current stock price on something that'll pay you a little bit better than 2 to 1 to the upside. Not terrible. But I wouldn't sell a whole lot of premium into this because, as you saw, I mean, this thing, it's kind of a coiled spring here. It's really whipped around. Okay. Oh, you got to. Oh, okay, good. So, Finwest. Oh, yeah, get into the wheel strategy. Yeah, so you sold a put the stock, write some calls against it. Yeah, I think that's fine. In that context, like if it's part of an overarching strategy where you're doing something systematically, I think that's fine. If I had no position, I'm just looking at this. Do I want to get into a credit trade, as a way to get long exposure, or maybe a debit trade by a call or a spread? I would prefer a debit spread as a way, no position, not sort of just working through a regular investment process. That's probably the way I would tackle it just going into the event, but that's fine. So Alex is asking, is there a chance of options volatility play on SPY and SPX with oil in Iran? So I'm curious, Alex, if the question here is, can you get long vol? I sense from your question that you're asking, is there a way to get long vol? And I'm not sure that that's a great move here. And part of the reason was, at least when I was only glancing at the VIX. I was on a call going into the close, so I don't know where we finished up, but it was around 21, 22-ish. At 21.15. Okay, so in that same vein. That's a little bit above average. I think do I want to start buying volatility at 21? Not necessarily. I guess whether you think this is a good idea or not is going to depend a little bit on your view of these events. And we always get into a little bit of ticklish territory when we start talking about geopolitical stuff, because people have different views, different perspectives on all of this. I'm trying to take the administration's statements at face value. And what that means is they have articulated some fairly straightforward and limited objectives. And their objectives were, they want them to give up their nuclear program. They want them to stop being a sponsor of terrorism. They have not articulated, much, much more complicated objectives than that, which might be, what would be an example? We believe that the Iranian people deserve to be able to determine their own future, and that they should have full, fair, and free elections. And we would like to see a democracy, a secular democracy, emerge in the country. That would be a remarkably ambitious objective. Arguably, it could be a very unrealistic objective. And it feels to me like something like that would also be tremendously costly in terms of lives and treasure to prosecute something that would accomplish those objectives. And I don't even know that that's even vaguely realistic. I'm not an expert on Iran. I have studied it a little bit. Took a class on it when I was in college, because I had several friends who were quite interested in that as an area. But one way that it was described to me, and it seems quite believable, it was a sort of like a heuristic, a simple way to think about it. And the comment was that 25% of the Iranian population would give their lives for the regime. That 25% of the population of Iran would give their lives to see the regime of Iran overthrown and thrown out. And 50% of the population of Iran just wants to live their lives. And the issue that we face is that we have this big barbell of factions and forces inside the country that are diametrically opposed to one another. One of them is very well armed. The other problem that we have is that the one that is very well armed is, fueled in part by religious belief. And can one debate with or expect a population or a group of people that are motivated by a religious belief to behave rationally? And I think the answer to that is probably not by the way we think of what rational means. They might act intelligently and they might act pragmatically, but it's incongruous what they view as rational to what we view as rational. So the question of whether we want to buy volatility on the S&P is going to be motivated in part by whether or not we have a limited set of objectives. And my sense of it is that what happened there was they thought, well, it can't be any worse than this. And we have not put boots on the ground in Venezuela, for example. So perhaps the attitude is we're struggling to negotiate with these people. They have highly enriched uranium. They said so. 460 kilograms, I think, at 60% was the number that they had cited, enough to make, by their own admission, 11 nuclear weapons or something like this. They said this is unacceptable. They wouldn't give them up, and they said we can't negotiate with them, and that's where we find ourselves where we are now. If that objective set does not move anymore, then I think the S&P can hold in. But I think it is also worth noting, let's just take a look. I don't know if you guys can see this, but we have pretty definitively now broken below the 50. We have gone now through the 100. It's not well through the 100. And then we had this one isolated day. That's, we're looking at this week right here. And maybe a better moving average to look at would be the one that our friend and colleague Carter Worth favors. So I'll put the 150 in and see how close we're getting. So we touched that, but we haven't violated it. But might we do that? And how would you put a trade on if one were? And the way I would probably do that would be to, I did this before. Where did that option play pop up? There it is. So I'm going to do this in SPY first. The way I kind of liked to play this was to say, okay, I'm willing to be long a little vol here. And recognize that, I might be overpaying a little bit. What I had been doing the last time I discussed this on this channel, which I don't remember exactly when that was. It was, probably at least a year ago, was looking out and buying a 30 delta put and a 30 delta call out, give or take a month. So we'll find a 30 delta call in here. So this trade is delta neutral when you initiate. Now, as you can see, if this is all you did and you just sat and waited, there's a lot of area in here where this goes wrong and just ends up costing and bleeding money. The upside break even is 714. All right, so we're looking at only just over a month in this particular case. So that's up 4.25%. And the downside, if you did nothing with this, okay? And the downside is 655. So that's down also about 4.5%, which makes sense. Now, what I had been doing when I put these trades on as a hedge against the broader portfolio was that I was actually managing the deltas. So as the underlying goes down, this position becomes shorter delta. And then I would just true up the deltas at the end of the day. Yeah. Okay, so, but it looks like you're thinking about shorting vol. So sell 30 delta put and keep delta neutral, but buy short SPY as discussed before. Yeah. So, yeah, that's exactly how I think I would trade this. I'm not really interested in just reaching out and buying premium and taking a punt on direction here. But yes, if you are willing to do that. Now, some of the people watching, you're probably not that comfortable with this whole idea. Or maybe you trade SPX. So let's just think really, I'm going to do this very, very quickly, or as quickly as I can. So, because we're coming up on the hour, but I think it's kind of an important topic. I'm rather glad we get an opportunity to talk about stuff like this here. I never get to do this on uh, television because it's a little bit more nuanced than they can probably accommodate in that format. But we'll just take a put in here, and I got to get out to April. You know, look, this is fine. So if I took it doesn't matter. I mean, I'll take a 40 delta put in this case. So if you happen to use something like SPX instead of SPY, so it's really easy if you use SPY. If I buy SPY and I want to get long vol, and it's a 30 delta put, I buy 30 shares of SPY for every put I own. And then at the end of the day or middle of the day, you don't have to trade it totally continuously. You look at the delta of the put, you look at the number of shares you hold. If the put delta has gone down to 20, then you adjust your share count to 20, right? So you're always going to be delta neutral in this way. I wanted to bring up SPX really quickly because I like to trade SPX because it's cash settled, and it's kind of nice when you use cash settled options because assignment or exercise issues don't really creep up. Just remember that when you're dealing with this, it is essentially 10 times the size. So when you see this 40 here on these 68.10 puts, so if I bought these puts because I wanted to get long vol, or if I sold them and always with a put, your hedge is going to be basically the same direction. So if I buy a put, I buy a stock. If I sell a put, I sell a stock to get delta neutral. Okay, so we should be good with that concept. So very quickly, I always use SPY actually to trade my deltas, even when I'm trading SPX. Just be sure to multiply by 10, and you'll be good. So if I bought one SPX weekly April 2nd 68.10 put, 40 delta, 400 shares of SPY, and I'm flat. And if you have a customer portfolio margin account, one of the things you're going to say is, well, you know, an SPX contract's a big contract. It is. It is a big contract. You're looking at notionally one combo in SPX is almost $700,000. But if you have a customer portfolio margin account and you are trading delta neutral, you're trading volatility, one of the things you're going to find is that the margin requirements for these things is not going to be that substantial. That's a double-edged sword. So it's not going to take huge capital commitment to do the trade I just discussed. And in any case, if you bought this, what you're talking about is $10,000 in premium. But if you hedge it, and if you have both the upside and the downside, you're going to find that it's not going to be massively capital intensive to do these trades. But just make sure you get the multiplier right. Okay, so with that, I have indeed taken up more than the full hour. But yeah, Alex, I do think that trading volatility in that way, this is really useful just so you get a better sense of how options behave. And the other nice thing about this, and I used a 40 delta put in this SPX example just because I only have 25 strikes showing here and don't want to spend too much time navigating things around. I wouldn't buy the 40 delta. I'd probably use a 30 or somewhere between 20 and 30 delta. But yeah, you absolutely can take advantage of that. By the way, one other quick point I would make is if you look at this, let me go down to now that I think about it, I will just go to the 30 delta really quickly. Reason for doing it is so here we are. Oh, I guessed right on 6,700, 30 delta. Is that you're going to notice that the 30 delta put out 1 month is often going to be trading at an implied volatility just because of the way things line up. Very similar to what the VIX is. So the VIX was 21.15. This is 20, basically rounding up. And that is a little bit high. So as you think about it, you can anticipate that if things calm down, and I'm really struggling to figure out how they're going to calm down a whole lot more in the next 30 days. I mean, I don't think everyone's going to come out and start singing Kumbaya. So we are in a little bit more of a choppy environment for the next couple weeks. Um, but hopefully that's all this is. And I hope things do settle down over there. Nobody wants war. Nobody wants a bear market. And on that note, I think we can wait until next week and see what happens over this weekend. May it be a little calmer than the last one. Thank you all very much for watching. Like, subscribe, and we'll see you here real soon.